Hey everyone, welcome back to our channel, where we simplify accounting and make it easy and accessible for everyone. Today, we're diving into an essential topic for anyone in business or accounting: inventory journal entry. So what exactly is inventory? In simple terms, inventory refers to the goods or materials a company holds in stock with the intent of selling them to customers or using them in production. Think of it as the items you see on the shelves of a store or the raw materials in a factory. Managing inventory properly is crucial because it represents a significant part of a company's assets and directly impacts profitability. But how do you keep track of inventory in your accounting books? That's where inventory journal entries come in. In today's video, I'm going to walk you through all the key journal entries related to inventory. From purchasing and selling inventory to handling returns, obsolescence, and even those tricky year-end adjustments. Whether you're an accountant, a student, or a business owner, this guide will help you get a solid grasp on inventory accounting, all in line with GAAP. So grab a notebook and let's get started with the first entry: acquiring inventory. When inventory is purchased, the entry depends on whether the purchase was made in cash, on credit, or if any discounts were involved. If purchased with cash, here is the journal entry. If purchased on credit, here is the journal entry. If a purchase discount is available and taken, for example, a 2% discount for early payment, here is the journal entry. Freight and other direct costs associated with bringing the inventory to its location and condition for sale are capitalized into the inventory cost. To record freight costs, here's the journal entry. When inventory is sold, two entries are made: one to record the revenue and one to record the cost of goods sold. Here are the two journal entries. When inventory is returned by a customer, you need to reverse the sale and the cost of goods sold. Here are the two journal entries. If inventory is returned to the supplier, the initial purchase entry is reversed. Here is the journal entry. If inventory value falls below its cost, an inventory write-down is necessary to reflect the lower market value. Here is the journal entry. If inventory becomes obsolete, a reserve or direct write-down may be necessary. Here is the journal entry to record obsolescence reserve and to write off obsolete inventory. At the end of the accounting period, if the physical count of inventory differs from the recorded amount, an adjustment is made. If physical inventory is less than the recorded amount, here is the journal entry. And if physical inventory is more than the recorded amount, here is the journal entry. When inventory is held on consignment, it is not recorded as inventory by the consignee until it is sold. For the consignor, when inventory is sent to the consignee, here is the journal entry. When the consignee sells the inventory, here is the journal entry. And there you have it. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more accounting tips and tricks.